The S&P 500 continues to make all-time highs. It feels like we're hearing this every single week, and it's interesting to hear Tom Lee's perspective on where he believes we're going to end 2025.
More than 15% year to date for the S&P, probably more than you expected in late spring. At the same time, we had this government shutdown, tariff headaches. So why should investors be more bullish on risk assets, the market overall, than they were 6 months ago?
Well, John, even at the April lows, just to be clear, our S&P year-end target was 6,600. So we were still expecting explosive recovery in markets. But we are above that level. And, we're 10 weeks before the end of the year and the S&P is at 6,800. I think it's still a base case then for people to say that in just a typical year, the S&P should gain another 4%. That would put us over 7,000 into the end of the year. And I think that that's sort of the minimum. But because we've got the Fed cutting, and they started in September, they've been on pause all year. That only happened twice in the last 50 years, which is 1998 and 2024. I actually think the S&P, given the skepticism that's been plaguing this market all year, we could do far better than 4%, maybe even 10% into year end.
So Tom Lee believes that there's another potential 10% gain in the S&P 500. And if we just look at the last week, we are seeing a lot of green. So there is the continuation of a very strong performance in 2025. And this is something that's also noted by Wall Street. They're seeing retail investors buy every single dip. Now, perhaps there is a case with the market being very strong, momentum looking very good, then you shouldn't have any cash on the sidelines. We're seeing lots of companies up double digit in 2025 alone. Some of them, in fact, you can see the likes of AMD, Palantir, Lam Research up triple digit. But it's really fascinating to note all of this whilst we're flickering between both fear and extreme fear. A very, very weird case where markets are at all-time highs, yet investor sentiment seems to be a little bit shaky. Now, not every single company is performing strong in the S&P 500, and they will likely get caught out once they've reported their earnings, and that is the focus on today's episode. 6 stocks that have already reported their earnings that have taken a hit, to understand the question, are they a buy, are they a hold, or in fact a potential trap? Now we're going to look at each one of these 6 very briefly. How did their earnings perform and what is our valuation today? The first one being Texas Instruments. Now earnings per share, they did have a narrow miss by 1%, in fact just 1 cent, with a marginal beat on their revenue, where we notice year on year earnings per share is struggling to gain momentum, but revenue was up 14%. Now this one is down in the last 5 days around 5.5%. Year to date it's also down around 10. If we zoom out to the last 10 years though, this one has managed to only slightly outperform the S&P, up nearly 200%. It is trading towards the lower end of the 52-week range, with really only one extremely weak buy rating from Wall Street, because remember 3.5 is the minimum out of 5 to get that rating. Both Seeking Alpha and Quant giving this company a hold. And if we look at the forward P sitting at 29.3 in isolation is fairly high, but couple that with the 5-year average being 25, we would call this a potential overvaluation signal. Note that at the beginning of 2025, this forward P was sitting around 40, so it has come down quite some way. Also worth flagging, the yield 3.4 does sit above historical 2.8, where when we do look at the blue tunnel, which as always for newer viewers highlights the intrinsic fair price, this one pretty much most of the last 12 months has been sitting above, so that is what we would indicate as potentially overvalued. During Liberation Day, where many companies were actually slightly undervalued, we noticed Texas Instruments went from trading at a premium to just about being in the reasonable signal. Something that when we zoom out to the last 10 years, we can in fact see this one more often than not doesn't really trade at a discount. You would only really be able to note this in 2023, going all the way back to 2016. Doesn't mean it's a buy, but definitely something that is interesting to point out. And the valuation grade overall does get a C+. Now that is ultimately because against the sector, they're trading at an 18% premium. against their own 5-year average, a 13%. And if we look at price to earnings growth, which is always below 2, does get us really excited, it sits at 2.61. Now that's a 45% premium to the sector overall, but what's really fascinating to note, over the last 5 years, this one has been trading at a PG of 4.6, so actually as of today, a 43% discount. I would say though 2.61 off the bat does look a little bit overpriced, especially when the sector does sit lower and we have a lot of high quality companies that in fact do sit lower, notably Nvidia trades at a lower PEG. Now our intrinsic value, and we will do this for each one of the 6 a day, comes to $166 derived from the discounted cash flow. Now we have here the growth rate moving forwards at 15%. You'll notice a low, medium and high, 10, 15, 20 respectively. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for TXN or any others, but based on 15% and the projected for 2025 in the 4 billion region, we use the discount rate that ultimately gives us the present value of future free cash flow, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. That 167 indicates downside of 1%, pretty much saying it is, as of today, around fair value. For those that want to see, and for transparency at 10%, $120, downside of 29, and if you believe we're being way too conservative, at 20%, 229, 36% upside. Quite telling that when we look at the reverse DCF, baked in today is 15.2% growth moving forwards to the future free cash flow, so it may be telling whether you already see this is under or overvalued. Growing faster than that, in your opinion, then it could be undervalued. If you believe it will grow slower, then overvaluation. Using the middle rate, as we typically do, we don't get a margin of safety today because we'd like to use 10% as a starting rate, execute buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If that was the case, then a buy at $150, but as of today, we're essentially saying you're paying a 1 to 2% premium. As we just showed you though, 10% margin of safety, a buy at $150, at 20%, a buy at $133, and 25, a buy at $125. Wall Street though, even with their incredibly weak buy rating, see this at 195 into next year. That is 15% upside. So let us know your views on TXN. Is it a buy, hold, or in fact a trap to avoid? The other thing we will note, for those that want to see this at the higher end of 20%, you are in fact getting a margin of safety sitting today at 26%. So let us know your views on Texas Instruments. Before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Sunday morning to your inbox, so one is coming tomorrow completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. November's copy will be dropping in the next few days. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're covering is Elevance Health, where they reported a nice beat on EPS, up 22%, a marginal revenue beat, although we can see year on year and quarter on quarter, EPS is in fact down double digit, and the stock over the last few days was down more than 2%. Year to date, this one's down 7%. Over the last 10 years, it has marginally underperformed the S&P. In fact, we noticed downward trend from August last year at $557. As of today, trading towards the lower end of the 52-week range. Double buy from Seeking Alpha and Wall Street with a hold from Quant. Forward P of 12.4, a little bit below their historical of 14, so a first potential undervalued signal. We do notice not that long ago, forward PE was sitting in the single digit, with a yield 2% above historical 1.2, and we do get the undervalued signal where it is very slightly below the bottom end, although do note the intrinsic price in the last few months has started to dip, not the greatest sign to see. And when we do zoom out to the last 10 years, we can in fact see two things. Firstly, intrinsic value has for the most part been increasing, just started to decrease in 2025. And more often than not, this one does trade in a reasonable signal. we do notice an instance in 2020 and in fact 2025 where you are seeing potential undervaluation. Now they get a B on valuation based on the forward PE of the sector at 19. You are getting a 40% discount to the sector overall and also a 20% discount to their 5-year average. In our intrinsic value, the average of the 4 models at $462. Firstly though, if you just want to solely look at a DCF, it does come lower at 374, where we've used a growth rate of 6% moving forwards. Baked in today is 5%, may give you a good idea if you do solely prefer looking at this model. 462 overall does in fact give you a margin of safety of 26%. Wall Street themselves see this at $400 into next year, 17% upside. Maybe this is one you like. Perhaps you're also considering UNH, or this sector overall in 2025 has been one to completely avoid. We then move into the telecom industry with AT&T, where their EPS was in line, a marginal revenue miss, and we can see earnings per share, no movement year on year, revenue up although very slightly. Remember, when you incorporate inflation at 4%, that is in real terms a decrease, and they were down around 4% over the last 5 days. Over the last year, it is up 13%. Over the last 10, this one in a huge downward trend, negative 25%. 10 years ago today, if you invested $10,000, you would currently be sitting without reinvesting dividends at $7,500. Currently around the mid to lower end of the 52-week range. Just one buy rating today from Wall Street, fairly respectable, 4.11. Although we notice the forward P sits at 12, well above the 5-year of 8, yield 4.4, well below the 5-year of 6.4. Both of these in combination highlighting potential overvaluation, and that is also confirmed when we take a look at the blue tunnel, consistently above every single month. The intrinsic value as well pretty much remaining flat, where when we do zoom out to the last 10 years from 2018, this one has been in a downtrend, and actually for the first time in the last 10 years, 2025, AT&T has been trading at a premium overall, and their valuation at a B, 15% discount to the sector, but a massive 39% premium to the 5-year average. Price to earnings growth 4.5, well above the sector, a near 200% premium. And our intrinsic value at $30 solely based on the DCF is yielding a growth rate of 3%, pretty much their 10-year average. Baked in today, 1.5%. Now you can see whether you use 2, 3 or 4%, each one does attribute upside to the current price. And if we do look at the 3%, MOS is in fact 17. Wall Street also giving this $31.52 into next year, 26% upside. You're also getting a fairly attractive 4 to 5% yield. At 20% margin of safety, a buy at $24. At 25%, a buy at $23. We'll also flag, if you want to be even more conservative, at the 2% point, you are getting a margin of safety, but much lower at 6. AT&T, buy, hold, or perhaps completely avoid. We then move on to Lockheed Martin, where they had a 9% beat on the earnings per share, a marginal beat on the revenue, although up fairly trivial, EPS 2% year on year, revenue much better at 9%, and they're down around 3% over the last 5 days, year to date pretty much flat, over the last year down 14%, over the last 10 underperforming the S&P, trading towards the lower end of the 52-week range, triple hold right across the board, where we notice forward P and their yield, both of them not too dissimilar from the 5-year average, so remember that translates to a possible reasonable signal, and that is also what we get when we look at the blue tunnel, pretty much been sitting in this tunnel for all of 2025, and when we do zoom out to the last 10 years, it does go through periods where it trades at a premium, at a discount, at a reasonable valuation, and as of today, and in fact most of the year, in that reasonable section. Now grading, they get a C, pretty much in line with the sector, but a 32% premium to their 5-year average. Price to earnings growth at 1.8, 4%, so marginal discount to the sector, but a huge discount to their 5-year, sitting at 47%. And our intrinsic value at $485 does in fact note here the DCF a little bit higher. Now we've used 7% moving forwards, baked in is just below that at 6.3%. But in combination of all 4 models, what we're seeing right now is that we believe Lockheed Martin is trading at its fair price. Wall Street see this a little bit higher, 536 into next year at 11% upside. And if you want to make note, 10% MOS, a buy at 437, at 20%, 388, and 25, 364. Lockheed Martin, is it a buy, hold, or maybe sell? We then move on to Domino's Pizza, where they did get a double beat, although fairly marginal on both accounts. Earnings per share was also down 3% year on year. This one's down around 1% over the last 5 days. Year to date, pretty similar results. Over the last year, this one's flat. Over the last 10, interestingly, nice outperformance of the S&P, trading very near to its 52-week low. We get just one sole buy rating from Wall Street, and this one forward P, the lowest it's been over the last 5 years at 22, historically 27. Yield marginally higher, 1.7 versus 1.2, and we get that undervaluation signal on the blue tunnel, which isn't something we have seen that often in the last 12 months. And when we zoom out to the last 10 years, also reflective of the same conclusion. This one, more often than not, trades in a reasonable or in fact at a premium. And if we look now, maybe one to consider if you do believe in the longevity of Domino's Pizza. With the valuation grade at a D, 34% premium to the sector, 19% discount to their 5-year average. Price to earnings growth, 2.4, so you are paying a 40% premium to the sector and not that dissimilar from their own historical 2.53. Now our intrinsic price comes to $515. DCF quite some way below at $416, which is pretty much in line with the current price. Now we've used 12% moving forward. That is near enough what is already baked in. So if you like this company, just understand at the current market value, the free cash flow projections over the longer term is 12% growth. Now using all three models, we get to 515, which does indicate 20% MOS. If you wanted 25, a buy at 386, pretty much around their 52-week lows. Wall Street themselves see this at 502 into next year, 21% upside. Let us know your views on Domino's Pizza. We then move on to Netflix, where we did have a miss on the earnings per share by 16%, revenue pretty much in line. We did do a deeper dive, so if you want to know more about this, do check out our video from a few days ago. EPS up 9% year on year, revenue up 17%, and they actually had their largest quarterly revenue increase in quite some time, sitting around 16%, and they've been able to increase their revenue from 2005 at a compounded annual growth rate of 24%. That is incredible to see, especially over such a long period of time. And we can see revenue, which is up 17% year on year, their largest driver coming from Asia Pacific, up 21%. We do, however, a little bit disappointed in noting their margin deficiencies, gross profit and operating down 1 percentage point, bottom line down 2, and they are in fact down 10% in the last 5 days. Year to date, they are still up 23%, and over the last 10, they have massively outperformed the S&P. They're currently trading around the midpoint of the 52-week range, with just one sole buy rating from Wall Street at 4.1 out of 5, where we also notice their forward P, in fact, sitting around the 42 mark, isn't the lowest it's been over the last few years, but is, as in fact, a downward trend from 2018, where it was sitting above 120. And whilst they get an F on the grading, 200% premium to the sector, pretty much around their own 5-year average, this price to earnings growth sits at 1.8. Now, yes, you are paying a 17% premium to the sector, but actually worth highlighting, historically their 5-year average has been lower than today at 1.47, meaning you are paying a 19% premium. Now, our intrinsic value, $832 derived from the DCF, is using the middle rate of 15%. Now, first things first, baked in is 19.4%. That will already tell you if you see this as over or under, or in fact fairly valued. Using the 15%, it does give downside of 24, meaning today, if you're buying at this 10% drop, you are in fact paying a 31% premium. Now, if you believe this rate is in fact reasonable, at 10%, a buy at 749, at 20, a buy at 665, and at 25, 624. Wall Street, though, incredibly bullish. They believe this is a massive buy the dip opportunity, 1,420 into next year, 30% upside. And if you believe we're being way too conservative, well, at 20%, 1,132, 4% upside, which would give a margin of safety of 4%. So if you believe this is appropriate, at a 10% MOS, a buy at 1019, at 20, a buy at 906, and 25, 849. Finally, we have gone the extreme here at 25. This is near enough where Wall Street see this, so they believe around 25% growth moving forwards. This indicates 29% margin of safety. So let us know your views on Netflix. Is it a buy the dip opportunity? That is what Wall Street sees, or maybe this is one to either hold or completely avoid. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.